Okay, let's go on with the program right now. Greg Weldon has been one of my favorites, my gosh, for so many years. And he does Weldon Online. You can find him weldononline.com. But I knew him from writing a book about gold market and the gold training boot camp and all sorts of things. But he's also the guy I describe, because this is how I came introduced to Greg's work, as the analyst that other analysts follow. Well, that's Greg. Why? Because he has a global reach. He has incredibly detailed work and understanding of how the different components of the global economy, global financial system fit together to come together with an investor's plan. So it gives me great pleasure to welcome Greg Weldon.
Thanks, Mike. It's my pleasure to contribute always. You guys do a great job, so I'm happy to be part of the team.
Well, you know what's interesting is that, it couldn't be better, for the World Outlook Conference. I was mentioning this last night where, we get all this anticipation about what the federal central banks are going to do, Federal Reserve Bank of Canada. Nothing happens. Now we project what's going to happen for the rest of the year. But come on, it's a debt-laden world. Interest rates are key individually and collectively. What's the impact on the markets? What's going to happen in commodities? That list is a long one. So let me just turn it right over to you and tell us what's going on.
Well, as you know, you just set it up beautifully for me. We are going to talk about all of those things today in what is really a sequel to my 2020 speech, The Age of Aquarius, and I call this one Sock Puppet Strategies. I will explain that in a minute, but first I need to kind of set the table here, and I need to explain some of the themes that have been important through 2021, the reason we've had such a good run in terms of, trading and so on in our market calls. And the first one is waiting for Godot. And, it used to be that the Fed was trying to pursue inflation. They were going to get inflation to 2.5%, and it never really happened. And the market, they would manipulate and puppeteer the market to get them to raise interest rates without the Fed having to do anything. And Godot, inflation never showed up, just like the play. Well, about a year and a half ago, I changed the ending of the play, Samuel Beckett's great play. And it's the alternate ending where Godot, aka inflation, actually shows up. That leads into the Kraken. What's the Kraken? Well, the Kraken is also inflation. As you know, the giant squid that attacks the ships, the pirate ships back in the 1700s type of thing. And, those tentacles, like, inflation, are reaching into every crevice of the ship. The ship represents the USS economy, the global economy, the Canadian economy, anywhere where people have to spend more for stuff, which is pretty much everywhere, and spending more for everything. So the Kraken is the tentacles, and it basically has the risk parameters and the strength to potentially pull the entire ship down under, aka the economy. All right, then you feed through the tiptoe through the tulips. That's the Fed. That's Jerome Powell. Why do we say tiptoe through the tulips? And we use Tiny Tim, of course. But it's the tulips are the tulip bulbs. The tulips are all the asset price bubbles that are everywhere right now. We see so many of them. And why is the Fed so afraid to raise rates from 0 by 0.25%? Because if they misstep and they step on one of these tulips, let's look at them as landmines, because you have the potential to do a lot of damage. They are still more afraid of deflation than they are inflation, even with inflation running amok to the upside. That leads us to the Wile E. Coyote market, which is the stock markets, including Canada, less so than the U.S. I think it's in better shape. But the U.S. market, if you know the cartoon, you have the Roadrunner, you have the Coyote. The Coyote is constantly chasing the Roadrunner. The Roadrunner just outsmarts him all the time, right? In this case, you kind of think it's the market and the Fed, and inflation is the Roadrunner. Well, ultimately, the Coyote runs off the cliff, and he keeps running, keeps having the wheels going, his feet are still going, but he's dead and he doesn't know it yet. To me, that's the stock market here. Mission Impossible is investors and the Fed trying to navigate this situation. If you remember the second Mission Impossible movie, Tom Cruise is like in the Grand Canyon hanging off rocks, by his fingernails. Insane, right? And when the hammer comes down, Michael, I know you talk about this a lot. It's important that we keep this in the focus with everything else. When the hammer comes down is one of our themes. The hammer is China. This is a comment that was made by Mao Zedong, all right, that communism is not about love. Communism is a hammer we bring down and use to destroy our enemies. That's his quote. Xi, as you know, his father was Mao's number 2 guy and happened to get killed in an assassination attempt. Xi, this is a manifest destiny psychology, and it's a manifest destiny philosophy, and they have changed their tune. It's not like cowering in the face of the West saying, you're running sweatshops, and they say, we'll try and do better. Now they're saying, look, your system's not working so well. Don't tell us how to run our system here. We'll do what we want to do. That's a big change in tone and tenor. You have Taiwan, and I have the slides in the PDF of all these themes, but we're not going to go through them all because I just told you. But when we get to China, just know this is just simple. If you want manifest destiny and you're China, you have old wounds with Japan. That's a whole nother story. But you can see why. It's the Philippines that wanted to declare war on China in 2021. Vietnam and Malaysia, airspace invasions. Taiwan is virtually under, attack. They're probing. They're seeing what the defenses are. Something's going to happen here eventually, and it's a big deal. You know my position on the currency. You know my position on crude oil, price in renminbi, traded in Shanghai, that they could dump the dollar anytime they want to. China is a big risk in the bigger picture. Before we go forward, we have to go back 2 years to the age of Aquarius, okay? This is a real scientific thing. For those of you who have never heard me on this before, the solar system itself moves in an orbit 25,800 years. It moves through 12 constellations. Those are your astrological signs. And in that context, you go from place to place in the galaxy, and you have a dynamic where there's different energies. There's pulsars and quasars and supernova in Aquarius. There wasn't much in Pisces. What happens is the planet gets bombed with more light plasma. This heats the planet up. It increases the volatility in the ionosphere. It increases the vibrations of the crust of the planet. Bottom line, you have polarization, and both ends of the spectrum become more volatile. Tell me we have not seen that. All right, here's the science. Here's the end result. It's not just that it's warmer. Of course it is, and that's not because human beings are driving SUVs. It's NASA has already redefined it. It's not global warming anymore. It's solar warming. Why? Because the ice shelves on Pluto are melting. Certainly not because people are driving SUVs. And, you want to talk about climate change. This is all directed at keeping the economies going with an engine of growth. It's way more important than changing the climate, which basically with the trends and the big long-term physics, you can't do it. You're talking about record drought and record floods, record heat and record cold. You see it in people, the chemistry, the brain chemistry, record extremism on the left of the political scale, record extremism on the right, all the way down to 1 point, increasing volatility. We called this in January, February 2020, and tell me volatility didn't explode. Certainly the pandemic was there, but that's part of it, all right? Now you got Tonga. Now you have the most active volcanoes right now that we've ever recorded, 29 of them. Look at how they are on the ring of fire. This actually has extended since this chart was created up through Cabo into Los Angeles, into Nevada, and into Oregon. So, kind of from that perspective, you can see it, you can feel it. It's in the markets too. And all of this is bigger risk than is definitely priced into the market. Part of what happens in the age of Aquarius is enlightenment, all right? The light exposes the dark. We know of so many things that are potentially being exposed. We've seen the pedophiles exposed. We've seen the corrupt Hollywood and politicians and all the really sick things that have been going on that nobody's cared about till now. It's being exposed, all right? All of a sudden now the Pentagon's releasing alien videos. We have a whole generation of people that have grown up with aliens. The Wizard of Oz and the greatest Ponzi scheme of all time are two themes that we used at the speech 2 years ago that apply now more than ever. Okay, the great and powerful odds. Central banks will pull whatever they're going to work their magic and run their fire, and they're going to say, hey, guess what? Stocks will never go down. Stocks will always go up. Paper currencies cannot catch on fire. All sovereign debt will be honored. There's no problem. MMT is the creation of all this. But you realize, exposed, it's just the central banker behind the curtain pulling the money levers to print more money. All of it's IOUs. You talk about Bernie Madoff, the greatest Ponzi scheme ever. No, it's the U.S. dollar. Since 71, since we gained seniorage, it's been a free-for-all with printing money. And what is the dollar? It's just another paper IOU, just like a bond. So in the case of this, when you're printing this much money, you basically could say, not only printing this much money, but how many times does this dollar get taxed? It gets taxed when I earn it, then I spend it, I have to pay the sales tax. The guy who earns it has to pay the tax, and then he might put it in savings, and then he dies and he leaves the two kids, and they tax it again. So, you could say the dollar is an abusive relationship. Why is no one rescuing the dollar? Well, this comes to a head when you talk about the bubble that we're in now. It's a 50-year bubble that has had cycles where each one has gotten bigger. Why? Because they have to print more money every time. All right. I remember the dot-com bubble. All right. I remember calling the crash in 2000 as well. All right. Back then it was pets.com. and sock puppets. That was the big thing. Remember pets.com? All you had to do was have a .com, and you had a company, and you could go public for tens of millions, if not hundreds of millions of dollars. Doesn't this sound kind of familiar to some degree in terms of getting rich quick on the basis of nothing? All right. And you take this thing where they had $20 million in sales and they didn't even have $40 million in sales. And they really didn't have the infrastructure to carry out their business plan. All right. And they went and spent $80 million, borrowed money to run a Super Bowl ad campaign using the sock puppet. The sock puppet became the most valuable part of this company. And what happened, it even got into the Macy's Day Parade, the only float that was not charged, the only float that ever got in for free. That's how popular this sock puppet was. It was in every commercial. Every celebrity wanted to be in a commercial with the sock puppet. All right. We have sock puppets today. Right there. Doge, Shiba. There's nothing to them. Not only that, you have 350 some currencies that trade on Coinbase. Hello, sock puppet strategy is what you need to do. You need not to basically get sucked into all this. Let's look at the global situation from the U.S. Asset bubble, the Fed, inflation, and the biggest thing of all is the consumer. All right, I almost want to jump right to that because it's really impressive and exciting to take a look at that. Let's start with the market, because the market itself is kind of the story here, and the market itself will be the catalyst, maybe even for what's coming next. You see this, bull market we had since the 2020 low. You're now violating the moving averages. You're violating the uptrend line. You got a double top here that was unconfirmed. The long-term stochastic, so overbought, it's not even funny. More than that, it's the simple angle. Look at the angle of ascent on this market for the length of time that it's gone up. It's unprecedented. And, we see the percent change has gotten to a point where in the past it's been led to turbulence. But using the angles, even going back to 2009, when you put this cone in here, I mean, we were exceeding that when COVID hit. And if you remember, it's kind of the same situation then. The market was going up, but the consumer was starting to kind of struggle a little bit. And in the case of COVID, it kind of accelerated all that. It didn't cause all that, or certainly caused everything since. But the point is, look how straight up and down and beyond the cone that held this bull market in check for 11, 12 years. And bam, let's print $8 trillion and see what happens. Well, this is what happens. The angles are insane. It's almost straight up and down. I mean, look at that. Look at the same angles applied to the 1900s and the 2000 bubble. You didn't even come close to the bottom end of the angles that you're chasing now. If you use just this, you're looking at a correction down somewhere towards 11,000. You've violated the first, you violated the second. The next move here again, somewhere between 11 and 12,000, potentially as low as 10. Then you start talking support, which you see around 9. I mean, so it's pretty heavy. The NASDAQ peaking against the S&P. If this double top plays out, that's big. The 2-year moving average replay of 1999. The cash S&P, I mean, on the back, it hasn't performed as poorly, and these charts are a little old, as you know, Mike, because I put this together over the weekend. But you see, for January, you have an outside-downside reversal month in the S&P. That's very rare. When have we had them before? Right prior to this move, and of course, right prior to the move in 2008. Amazon. I mean, Amazon is the benchmark bellwether blue chip in terms of the consumer, for sure. I'm a guy who swore I would never use Amazon, and I'm an Amazon junkie now, so everyone uses Amazon. But more than that, everyone owns Amazon stock. Every passive investor, every passive fund, every hedge fund. If you don't own Amazon, you're threatened. You're being threatened with trailing the market and underperforming, and having assets redeemed because you're not on board Amazon. So what happens if everyone wants to liquidate Amazon? I mean, it's a $3,000 a share stock. The volume is virtually nothing now, because how many shares can you trade with $1 million? How much money do you need to be a block buyer if this thing is coming down? You could have a buyer's vacuum, which is kind of what you've seen over the last 2 weeks. This could be something that, if you get a rally, you're going to see what happens. You kind of saw it in the NASDAQ already this week, where you got a rally and all of a sudden sellers came out of nowhere. Why? Because people are a little afraid here. And if they get a rally, you might see a move to take profits and liquidate. Look at Amazon. Anyone that bought Amazon since the early part of, or at least the mid part of 2020, is losing money. They're bleeding right now. It reminds me of the song, Bloody Red Son of Fantastic LA, when there's blood in the streets. I mean, it's kind of the way it looks right now. When you look at any of the internet, retail, consumer-based entities, the PNQI is one of the best ETFs to gauge this. It has been a leader since 2009. I've been following it since 2009. We've been long it and made a lot of money in it since 2009. And now it's breaking down big time. More than that, the relative performance against the S&P 500 in purple against the PNQI itself. It has outperformed the market. Every time you got a wiggle to the downside, it was a warning sign. And this is more than a wiggle. I mean, this is more than an aftershock or a pre-shock. I mean, this is an outright earthquake going on right here, right now. Now, in terms of the consumer, Mike, I mean, the bottom line is you've had a 170% rally in the consumer discretionary ETF since the 2020 low. 170%. Do we think the consumer is 170% stronger? Obviously, a lot more involved, particularly the printing of $8 trillion. And everyone talking about how strong the consumer is because you just passed out $8 trillion. You got $6.6 trillion in savings. You got people earning, $50 a week more than they were earning before. And, seemingly everything was good until inflation started to rise. That changed the whole narrative, not only for the Fed, but for the consumer. And we're going to show you that in stats in a minute. But the S&P Consumer Discretionary Index against the S&P 500, again, has been telltale. And this is very much a very loud warning sign in terms of an unconfirmed new top, violating the trend line. Goes back to the 2009 low, violating the 2-year moving average. Technically, this is a mess. And relative to the S&P 500, here's the ratio in black, the S&P 500 in blue, peaks first. Bottoms first, leads higher, leads lower, bottoms first, peaks, gives you warning, gives you warning. This has been a phenomenal early warning sign of a storm coming, and it is screaming. It is a very loud siren that you can't shut off right now, that there's some trouble coming. This ratio, which has been uncanny, really, since the 1990s, is projecting an S&P somewhere closer to 3,500 right now. That's a big move from where we are today in the 4,400 range. Let's talk housing. We've seen some erosion in U.S. housing. Canadian housing, by the way, on fire, and I'm going to talk about Canada in a minute, but not so in the U.S. to the point where, and people are so willing to say, well, it's a lack of supply. And it is, but it isn't. It is more a function of affordability. Prices are up. Here's the mortgage bond securities ETF. In other words, the mortgage rate inverted. I mean, it's collapsing. I mean, this is a massive move that you didn't even see this kind of move in the early stages of 2007 that you have going on. And the degree to which the home builders with an unconfirmed new high now running the risk of breaking down, that would be big. Why? Because you have interest rates going up. The cost of materials has gone up. Even buying land has become a little bit more, certainly more expensive and in some cases more difficult. There is a shortage of supply, but we have seen sales decline at times when supply is rising in the past 6 months too. So it's not just that, it is a bigger picture that is more negative. And the degree to which the mortgage bonds relative to treasuries, that spread is blown out. I don't see that changing anytime soon. And to get any kind of refi support, you'd have to see the mortgage rate somewhere, closer to 2, if not below 2 and a 1 handle to jig all that money back into play. And it's just that's not going to happen anytime soon. In my mind, no doubt about that. So that leaves, kind of commodities. I mean, commodities are breaking out to the upside. This is the old CRB index refurbished. And, that really has been the play. I said 2021 be the year of commodities, and that really played out very well. Now, in the context of how does this play out with the Fed? The Fed was, basically waiting for Godot and thinking Godot was never going to show up and they could play the same old song and dance and it would work, and it hasn't worked. So now they do an about face. I mean, this is a major shift, man. When you say may become warranted to increase the federal funds rate sooner and at a faster pace than we had anticipated. A less accommodative policy would likely be warranted. Members see they will begin shrinkage more quickly relative to the first hike in the 2014 experience. There'll be a faster pace of policy rate normalization, given that inflation is higher than in the past. And shrinkage could happen much more quickly in the past, meaning the Fed would actually be, taking their balance sheet down, meaning they're not going to rebuy when stuff rolls off their balance sheet. They'll let it roll off as it matures. And that's, again, you're talking about the Fed is going to stop buying $1.44 trillion at annual rate just when public borrowing is going to be at the highest ever at $2 trillion. Think about what that means for the bond market. And not only that, let's talk inflation, because inflation, the price of everything's gone up, all right? And the Fed has kept saying inflation's transitory, and they're basing this on the base effect. The crude oil, is only up because, it was minus, the WTI, and it got down to whatever it got down to in Brent, and gasoline got down to 35 cents, in the futures market. So, of course, you have a base effect that's going to make inflation look higher than it is, but it's transitory because the base effect will roll over. Number one, it will roll over, just not as quickly as they thought because energy is making new highs. And I said in the early second quarter of last year, the worst scenario for the Fed in the fourth quarter would be if you're just about to start pushing in, which would have happened in February and March, really next month with some earnest, the base effect would have kicked in. All right, now you've pushed it back to August because crude oil, the worst thing that could happen for the Fed is the energy prices rise month to month to month, exacerbating the base effect. And that's exactly what's happened. More than that is this chart where the Fed says inflation will be transitory, so it'll come down to 2 or 3%, which is on top of the 8% we got now. And the 8% price hikes are permanent. Mike, you know that. Everyone out there knows that. Those prices aren't coming down. That defines transitory. It's not transitory. This inflation is permanent, and it is destructive in that vein. It's destructive to the very same people that Jerome Powell is so fit on bringing, including into the employment dynamic. These are the people, anyone below $58,000 a year median income in the U.S. is struggling to make ends meet when everything costs more. And we'll get to that in a minute. The Fed is still adding. The ECB is still adding, but you can see the degrees to which it's come down. Let me tell you something. 80% now, 50% now is a lot more money than it was in 2009. So Powell says this is the year in which this is just last week, we will move steadily away from the very highly accommodated monetary policy we put in place to deal with the economic effects of the pandemic. And he said here the potential for less accommodated policy over the next few years, again, it's not going to, something happens, they're not going to come right back in and print more money and cut rates. They can't, first of all, on the second point, all right? But that this would create a notable rise in the 2-year and 5-year notes. That was one of our big plays in 2020, being short the 2-year note. And it's still got room to move. It is still in play. Why? Very simple. This is the end of this year, end of 2022, forward Fed funds rate. It's 1%. If we take the top end of the current range at 25 basis points, that's implying 100% odds, according to the market, of a minimum of 3 rate hikes. You could price in another 50% because the actual effective Fed funds rate is only 9 basis points. All right, but let's be conservative in our view. 3 hikes priced in at a 1% Fed funds rate. The 2-year note's only 1%. Wait, it's 2 years. They're going to be raising for years. The 2-year Fed funds swap is at 2%, which makes more sense. There's 100 basis points of VIG still to be had in the 2-year note. It's way behind. The 2-year note is acting like a 1-year note right now. And basically, there's still some belief in the bond market. Really, it's still that there's enough liquidity. When that liquidity dries up, you'll see this adjust very quickly. And where could it go? I mean, you're still at one of the lowest levels ever on a real basis relative to what is now 7% inflation. I mean, it's still minus almost 6 full base, 6 full percent, 600 basis points. The real 2-year note. We got short the 2-year, inverted here. So as this goes up, we're making money on our short, and it's been one of our big trades in 2021. And frankly, it was a pretty easy call for all the reasons I'm saying, because the Fed funds swap started pricing it in, and the 2-year Treasury note didn't budge. Look how much it did not move. And finally, it's like holding a beach ball under the water level in a pool. So let's talk to consumer real quick before we get to our final stage here, because the bottom line is, you hear on TV still every day, it sickens me to listen to these guys who tell you the consumer is stronger than ever. All right. The consumer is not stronger than ever. And here's why. The consumer is telling us that they're not stronger than ever. The first thing is inflation. Consumer inflation expectations. All these next charts are from the New York Fed household survey done every month. It's a treasure trove of information. I love the day that this comes out. You get the median prediction for inflation for the next year, a year from now, is 7%. In other words, transitory not is going to stay where it is. All right. The upper dispersion of the estimates by consumers and households is 8.5. Worse is the 3-year rate. So you talk about transitory. The 3-year predicted rate is 5.2%. The average is 4. The Fed is not, the market is not priced in for a 4% inflation rate for the next 3 years. Absolutely 100% not. Let alone the top end of the dispersion is 8% for the next 3 years. Wow, wouldn't the Fed be screwed? You'd have to call Paul Volcker back from the next dimension to handle monetary policy. Now, the Philadelphia Fed, the Fed does a lot of interesting surveys. The Philadelphia Fed's one of the best ones. A lot of information here. I'll make this real simple. In August, firms in the Philadelphia region expected to get 5% for their finished goods. Now they expect 5.3. More than that, for the next 10 years, manufacturers were saying it will cost consumers 3.5% a year for finished goods, up from 3 in August. 3.5% inflation expectations for 10 years. That should have been sending alarm bells to the Fed. In terms of the consumer, all right, they continue to get money from the government. I mean, the latest numbers, these numbers just came out. They're lagged a month as opposed to other data that comes out. All right, $4 trillion is the transfers. The handouts are still $4 trillion. This is why the deficit is going to be so big again. All right, this is not sustainable. I was kind of surprised to see that this hasn't come down more. But what's come down is savings. Every guy on TV tells you, you got a huge pool of savings. They're thinking about a year and a half ago when savings pool was 6.6 trillion. It shrunk steadily ever since. It's 1.2. It's lower now than it was before the pandemic. All right. So you have no savings. You have inflation that has eaten up to $2,600. The average American is making more than they did a year ago, by far, when you're paying more for everything, including childcare. And if you work and commute, all these things, and let alone food, let alone gasoline, let alone necessities, rent, shelter, all these things, insurance, everything has gone up, and your savings have disappeared. So what have consumers done to maintain their spending that gives this impression that everything's copacetic? Record consumer borrowing in November. Record for 1 month. 3 months, over $35 billion for the month, 3 of the 5 highest months in U.S. history. The consumer is choking, and you see the signs in the data. It's there. The last part of this is the Fed's dynamic around their household survey. Are people better off or worse off? Here's the better offs up here. In these 2 categories, here's the worse offs. I took all the numbers and put them into a form that's really easy to see. Versus 2 months ago, you'd think people are saying they feel better off 12 months from now than they would have said 2 months ago. No, the better offs are down. The worse offs are up over the last 2 months. Compared to before the pandemic, 44% of people said they would be better off 12 months from now. That's dropped to 26%. Only 9.9% of people said they would be worse off. That's risen to 26%. This has gone from a 4.5 to 1 ratio to even. This has gone from less than 10 to 1/4 of people, of households. And the Fed says, don't worry about asset prices. It's not a risk because the households are in good shape financially, more than they've been in years. Now, of course, he's not going to tell us the reality because he needs to maintain confidence, but he knows better. Bottom line is the 2-year note is rising. We called this in terms of curve flattening, catching up with the rest of the curve. The expansion, the rise in the 2-year also causes the U.S. interest rate premium to Europe to expand, black line here, which boosts the dollar. Now the dollar's breaking out. That's a new move here. And that is part of tightening monetary conditions. And that's bad for asset prices. And you can see now if we get a rally, there's a breakout that portends something along the lines of a 102 to 104 move. In that case, you'd have double-digit year-over-year rates of gain. That's bad for asset prices. Not only that, the gold-adjusted value of the dollar tells you whether monetary conditions are easing or tightening. It's a breaking out to the upside in terms of tightening. You can see it breaking out. Could that mean that gold is just destined to go the way of the stock market with all assets like it did in 2008, at least in the first phase of this? Maybe. I don't think so. But we have to be on guard here. The silver equities don't look good. The gold equities don't look good. And this price action has not been good. This should have broken out. It didn't. The dollar's breaking out, and that's a problem for gold. So how do you deal with all this? Is it mission impossible? I've been around for 38 years. I called the crash in 87. I made a ton of money, and I was young and stupid, and I spent it all, right? So 1990, I was at Lehman Brothers. I just started at Lehman Brothers. I was there actually about a year. And my boss, Howie Levine, one of the greatest brokers, a great guy, used to go on FNN at the time. And he used to go on all the time. Well, he was on vacation. They called me. I said, sure, I'll go on. So I went on and I said, I expect a 30 to 40% decline in the stock market right into the 1990 peak. When I get back to the office, I'm called up to the executive offices upstairs, and I almost lost my job because over the weekend, it was a divisional playoff NFL weekend. Shearson Lehman, who I was working for at the time, had spent tens of millions of dollars on a bullish stock market ad campaign featuring Elaine Garzarelli. And I go on TV as Shearson Lehman and say the stock market's go down 35 to 40% on the day after those ads ran. They were not happy. I didn't lose my job, and I kept going on TV. I turned out to be right. 2000, I was on a show called The View prior to the really popular show The View with Ted David, my buddy Ted David on CNBC. And I happened to be doing the calculations that morning. You know, what do I think the stock market could do here? And the NASDAQ was at 5,200. It had just kind of peaked at 5,800 or whatever it was, and it come down maybe 500-600 points. And he says to me, and we didn't talk about stock, so he called me off guard with this question. It was only because I did the math in the morning. I even knew what I, just reacted. He says, how low can the NASDAQ go? And I blurted out 1,300, which I just called on national TV for an 85% decline in the stock market. I was never asked back. It was weekly. I was on every Wednesday. That was the last time I was on the show. And I emailed Ted David 8 months later when the NASDAQ fell 85%. 2008-9, if you read my book, I called that crash. 2011, 2020, I called it at the speech. All right. What do you have to do? You have to broaden your horizon. And I mean, truly diversify, not just, am I going to do solar and consumer discretionary and no, you need to be talking about all the opportunities to be long and short. And you can use ETFs to this degree. I think futures markets are a great, vehicle for this kind of stuff. All right. You have to add commodities and currencies. Paper has to be added because there's going to be huge opportunities there. Equity indexes and bonds, you want to be short at the right times. And certainly commodities and commodity producing currencies going forward will be bullish, at least better than some of the paper assets. And depending how this plays out, you could see stagflation, where maybe some of these commodities don't roll over with paper asset prices and keep going up and cause this to be worse. That's what I kind of see playing out. So you want to take place, you want to be able to take advantage of all the moves in everything, and that just gives you better chance for success. You want to be in bonds, deposit rate stocks, currencies, the whole range of the commodities, base metals, precious, energy, grains, especially the food commodities, soybeans taking off again, corn, really like that area. Cotton has been a big play too. Opportunities in Canada. I mean, exports at a new high. The housing market's on fire. 10%, increase year over year in home prices. You have new highs, new all-time highs in Canadian housing permits just released the other week. While inflation is higher, it's not out of control like it is in the U.S. And you have an economy and a stock market that's has a good base in resources. So I like the Canadian dollar kind of longer term, but I like gold and Canadian dollar more. So how that looks, and I love the TSX Canadian stock market against the S&P 500. So for the Canadian, crowd, which is probably most of you, that's my view there. And opportunities globally, you want to be everywhere. You never know when the next thing is going to come. The next currency is going to be that's going to be a big move. So you want to be involved globally, and that's what we do. And if this is something you don't feel comfortable doing yourself, or if futures are not your thing, futures markets to me are just a great vehicle. You have to know the math. We do boot camps on our website about how to trade the futures market and how to manage the math. The great vehicles, we've had a great run recently. I don't normally hawk. 20 years I've been dealing with Mike and contributing with all the great projects that Mike's involved in. I've never hawked the money management business. It's just really a tight circle of people that I allow in on that. But I'm telling you, to me, I feel like it's a call to arms almost. And you got to help people sidestep and take advantage of what's coming next. So we are a registered Series 3 licensed CTA in the U.S. Everything that we do is 100% transparent. You have your own account, your own money. It's only you that can touch it. It's held in your name only. You get disclosure every single day you get. If you want, you don't have to get it, but you get a report if you want it. Shows you the positions, the day's profits and losses, the cash value. Everything is transparent every single day, and there is no lockup. You don't like what we're doing with your money, I don't feel comfortable managing your money. There's no hidden fees. We don't derive income from brokerage or trading or anything else. All right. So what I would say and leave you with is pretty simple. Okay. Qualified investors, $1 million minimum, and $1 million minimum, because these contracts are so huge. Crude oil is going to be above $100 a barrel again. I have very strict management based on math. And when I extrapolate and, back engineer the math to get to the minimum investment I need to feel comfortable that I don't have a high risk of ruin and that my drawdowns can be what I want them to be within the curve of what the profits are going to be. 1.5% annual management fee paid monthly, 17.5% of new profits paid quarterly. Email me there for info. And the last thing I would leave you with, And really, it's just so important because I saw so much pain in 2001. I saw so much pain in 2008. Okay, don't be a sock puppet. Okay, don't let your money deflate like a sock puppet balloon, because your money is increasingly at risk every time that the wizard behind the curtain pulls the lever. That's it, Mike. Back to you.
Well, that was terrific, Greg. I just want to emphasize one thing you said there. When you were talking about the individual savings rate, and it's a great example of why analysts read Greg Weldon. And that's because the narrative is, oh, we've got $8 trillion ready to spend. We've got this ready to go, this ready to go. And what Greg does is he looks at the data. And when that drops down to 1.5, 1.2, that's an example. The environment's changed, but you're not reading it anywhere else. And I just was listening to that thinking that's exactly why other analysts look at what Greg's doing so we can get them up to date what's going on. The other thing, and just quickly, Greg, we only have a minute here, but it also reminds me, it's a different time now that people have to pay even more attention. I'm thinking the energy market's a great example, you look at these outrageous prices paid in China, Germany, UK, et cetera. And that's why they need, to subscribe to services like yours, somebody they're paying really, it's like getting you to work for them full time, but it's because the environment, it's no longer one that you can just fall asleep on as you eloquently expressed there. I mean, look at these charts. Look at what the potential is there. Opportunity, yes, but huge risk too. And that's my impression of what's going on right now. I used to say stuff like, well, you just wait 3 years. No, we don't have to wait anymore. It's happening right now. So as I said, Greg, that was absolutely fabulous, and thank you so much.
My pleasure, Mike. I mean, buy and hold is dead. You have to be more active. You have to be more nimble. You have to be more flexible. And, there are going to be times when aggression will pay off, and there are going to be times when, running for the covers will pay off as well.
Well, I'll just remind people to go, and again, they can, of course, watch your presentation again because we give them an archive tomorrow, but it's also go to weldononline.com, weldononline.com. Greg, many thanks.
My pleasure, Michael. Take care now.
We're going to take, I've got to go. We've got Mark Leibovit coming up. He's going to talk about cryptos here. First time he's done that for us. He's talked about blockchain before and Bitcoin before, but we wanted him to give a presentation on the whole crypto market, so we're doing that. But we also got Ozzy coming up, Ryan, Eric Nuttall, I'm looking forward to him. The list is a long one. You can look at it on your program and your agenda there. And so stay with us. We got Mark next.